This person doesn't exist. Neither does this one or this one. They're completely synthetic, fabricated from stolen data and AI. And last year, they walked into banks, opened accounts, built credit histories, and stole $3.3 billion. They passed every check: KYC, liveness detection, credit bureau validation, everything. In the next 20 minutes, I'm going to show you exactly how these synthetic identities are built, step by step, why your traditional controls fail to catch them, and what actually works to stop them before the bust out. Plus, I'll reveal the single red flag that catches 90% of synthetic identities, one your systems probably aren't even checking for. This is the deep dive your compliance team needs. Here's what makes synthetic identity fraud the fastest growing financial crime threat. There's no victim to report it. When someone steals your identity, you notice. You call your bank, you file a report. But when the identity was never real to begin with, the fraud is invisible until the money's gone. What I'm about to show you is designed to help you and your institution defend against this threat, because understanding how these attacks work is the first step to stopping them. And the scale is staggering. Over 80% of new account fraud is now synthetic. That's not a typo. 80%. We're talking about 2.5 million compromised accounts in the US alone. So let's break down exactly how they do it. Let's start with what synthetic identity fraud actually is, because if you don't understand this, nothing else I'm about to show you will make sense. This is not traditional identity theft where someone steals your established identity. Synthetic identity fraud is a hybrid. It combines real and fabricated personal information to create an entirely new fictional person, a person who looks legitimate in your systems but has never actually existed. Here's the classic formula. Take a real social security number, add a fake name, a fabricated date of birth, and a fictitious address. The result? A synthetic identity. The identity doesn't belong to any single real person. It's a composite, a Frankenstein creation. Why is synthetic identity fraud so effective? Because every verification system is built on one fundamental assumption, that the data submitted belongs to a real person. When that assumption is false, when the person never existed, the entire system becomes a tool for the fraudster. Your checks are validating fiction as fact. And here's what makes detection so difficult. Time is on their side, not yours. With traditional identity theft, victims typically discover the fraud within days or weeks. With synthetic identities, there's no victim checking their credit report, no one calling to dispute charges. Fraudsters can operate for months, sometimes years, building credibility before they strike. By the time you detect the loss, they've already moved on to the next institution. There are three primary methods fraudsters use to create synthetic identities. First is identity compilation, also called Frankenstein fraud, where a real SSN is combined with diverse fake elements. Second is identity manipulation, subtle alterations of a real person's data, maybe a slight name variation or an address tweak, just enough to create separation from the original. Third is identity fabrication, entirely invented personal information created from scratch. No real person's data involved at all, pure fiction that passes for fact. Where does this stolen data come from? Data breaches, the ones that hit the news and the ones that don't, feed underground marketplaces where personal information is bought and sold. The most vulnerable victims are often those least able to protect themselves. Children whose SSNs can be exploited for years before they're old enough to apply for credit and discover the fraud. Other populations frequently victimized include the elderly, incarcerated individuals, the recently deceased, recent immigrants, and those experiencing homelessness. What do these groups have in common? Their identities aren't being actively monitored. They're unlikely to discover the fraud themselves. This is why your institution has a responsibility to detect synthetic identities at onboarding, because the real victims often can't protect themselves. Now let's examine the fraud lifecycle. This is what we call the long game, and understanding it is critical to detection. Fraudsters aren't impatient. They invest months building credibility because larger payouts come with time and trust. Phase 1 is fabrication, typically weeks 1 and 2. The fraudster obtains a real SSN, maybe from a data breach your institution was part of, and pairs it with fake identity elements. They submit an initial credit application, and it's usually denied. But here's the thing you need to understand. But here's the critical insight you need to understand. That denied application creates a credit file at the credit bureau. This is the moment most institutions miss. The synthetic identity now exists in the system. It has a clean credit profile with no negative history, just a blank slate that looks like a legitimate new consumer. If your detection doesn't catch it here, at this moment of creation, you're already behind. Phase two is legitimization, spanning months 1 through 5 or longer. This is the deception game. The fraudster adds the synthetic identity as an authorized user to a real person's account in good standing. When the real cardholder makes timely payments, a positive trade line gets reported for the synthetic ID. The fraudster is building a false credit history on the back of someone else's good behavior. Meanwhile, they're creating a supporting digital footprint, social media accounts, email histories, employment records, all fabricated to create the appearance of a real person. This is why your verification process can't rely on a single data point. When you're checking an applicant's digital presence, you need to look for the signs of fabrication. Recently created accounts, thin history, inconsistencies across platforms. A real person leaves years of digital traces. A synthetic identity was born yesterday. As the credit score improves, the fraudster applies for higher credit limits. The profile now looks legitimate. Decent history, good payment record, increasing credit access. This can continue for 5 months to over 2 years. Then comes phase three, the bust out. The fraudster maximizes all available credit lines simultaneously across multiple institutions, possibly including yours. Then they vanish without making a single payment. By the time your collections team reaches out, the phone number is disconnected, the address is a vacant lot, the person never existed. Financial institutions are left holding significant losses. And here's the devastating reality: there's no real person to pursue for collection or recovery. The identity was never real. Fraud rings may operate thousands of synthetic IDs simultaneously, all waiting for the bust out signal. Let me give you some real numbers. The largest detected fraud ring operated 7,000 synthetic identities and caused $200 million in losses. Adam Arena's New York ring used 13 co conspirators and over 20 identities to steal $2 million from banks and COVID relief programs. In Atlanta, Corey Cato's ring operated undetected from 2017 to 2022, extracting $2 million. In Ontario, Canada, a ring ran for 8 years with over 680 synthetic identities before anyone noticed, causing $4 million in losses. But knowing how they operate is only half the battle. Coming up, I'll show you the exact signals that expose these identities, including the one that most automated systems miss completely. Now, here's what most compliance teams get wrong. You'd think with better technology, AI fraud detection, behavioral analytics, machine learning models, we'd be catching more of these. But the detection rate hasn't improved. In some cases, it's gotten worse. Why? Because the same technology that's supposed to protect you is now being used against you, and fraudsters are adopting it faster than you are. So, how do you actually catch them? Let's examine the red flags that can expose synthetic identities, the detection signals every compliance professional needs to recognize. These are the patterns that slip through automated systems but stand out to trained eyes. Start with credit file anomalies. Look for thin credit history with only low limit accounts of $1,200 or less. Watch for unrealistically high credit scores despite minimal credit activity. Be especially alert for authorized user-only status. When someone's entire credit history is built on piggybacking off other accounts, that's a major warning sign. Also, flag high velocity inquiries, multiple credit applications in a short time frame. Age credit mismatch is a dead giveaway. When a 55-year-old applicant has only a 2-month credit history, something doesn't add up. Real people leave financial footprints throughout their lives. Your system should be flagging this automatically, but most don't. Now, these next signals, they're the ones most compliance teams miss entirely. Your automated systems probably aren't even looking for these. Pay close attention here. This is where synthetic identities slip through the cracks. Identity data inconsistencies are critical and often overlooked. Check if the SSN was issued before the claimed date of birth. That's impossible for a real person. Look for SSNs on the Death Master file or flagged as never issued. These checks take seconds but catch fabrications that look perfect on the surface. When multiple names are tied to a single SSN, that's obvious fabrication. The same goes for name phone email combinations that don't logically connect, clear signs that identity components have been stitched together from different sources. Geographic and device signals reveal coordination. When your customer claims to be in Germany, but the IP address traces to the US and the phone number routes to Nigeria, that triangle of inconsistency is a massive red flag. Watch for the same device across multiple accounts. When your device fingerprinting reveals the same hardware signature across dozens of supposedly different applicants, you've found a fraud ring. Addresses clustered near major airports or mail receiving agencies are trafficking hubs. Shared contact information, the same phone or email appearing across unrelated accounts, indicates coordinated fraud. Behavioral red flags include multiple applications from the same device or IP within a short window. Look for coordinated timing where multiple accounts activate simultaneously or accounts that sit dormant then suddenly burst into activity. Examine their digital presence. AI generated profile photos have subtle distortions, asymmetrical features, strange backgrounds, earrings that don't match. Social media accounts created recently with minimal historical content are fabricated identities. When a search yields no results for an applicant, question whether they've ever existed. But here's the problem. Everything I just showed you, it's getting harder to detect because fraudsters have a new weapon and it changes everything. Everything I've shown you so far? That was the old playbook: manual fraud, human scale operations. What I'm about to show you is different. This is where the game fundamentally changes, and where most institutions are completely unprepared. Synthetic identity fraud is not new, but generative AI has supercharged its scale and realism beyond anything we've seen. What previously required a coordinated fraud ring of 20 people can now be executed by one or two individuals with the right tools. This is the threat environment you're now operating in, and why your detection capabilities need to evolve just as fast. Generative AI creates realistic government IDs in seconds. Bank statements, pay stubs, employment letters, all fabricated with high fidelity. These fake documents are legible and logically consistent, which means your traditional OCR-based verification won't catch them. Your document forensics needs to go deeper, examining metadata, compression artifacts, and security features that AI can't yet replicate convincingly. Deepfake liveness attacks are now sophisticated enough to defeat basic verification systems. Real-time face swaps can replace a fraudster's face with the synthetic identity's face during live video verification. Natural microexpressions, blinks, head turns, eye tracking can all be synthesized. If your liveness detection relies on simple motion checks, it's vulnerable. You need multi-frame analysis, challenge response randomization, and latency measurement to catch these attacks. The statistics are alarming, and they should inform your investment priorities. Deepfake fraud attempts increased 1,100% year over year. And here's the critical vulnerability you need to address. Deepfake voice detection accuracy in most systems is as low as 38%. That means current voice verification is failing more often than it's succeeding. If your verification stack includes voice biometrics, you need to know its limitations and layer additional defenses. The injection attack vector is particularly dangerous. Fraudsters feed fake video directly into the camera input of verification systems, bypassing liveness checks entirely by replacing the legitimate camera stream. But here's your defense. Synthetic media struggles with challenge response latency. That timing delay between prompt and response is a key detection vector your systems should be measuring. If your verification doesn't check for injection attacks, you're leaving a major vulnerability open. AI can generate batches of synthetic personas in minutes. When initial applications fail, systems autocorrect, adjusting dates of birth, names, and details until approval is achieved. They create complete digital footprints, social media history, employment records, email trails, all cross-consistent. This is why your detection can't rely on a single check. You need velocity analysis across applications. You need device fingerprinting to catch the same machine submitting dozens of different applicants. One data point won't save you. This is what you're up against: AI tools have fundamentally changed the economics of fraud. A single operator can now deploy 100 or more synthetic identities simultaneously. That means your institution isn't facing one fraudster at a time. You're facing industrial scale attacks. Your defenses need to match that scale. Manual review won't cut it anymore. You need automated detection that can process thousands of applications and spot the patterns that connect them. Synthetic identity fraud intersects directly with money laundering, and this is where it becomes an AML concern, not just a fraud concern. Criminal organizations are increasingly using synthetic mule accounts instead of recruiting real money mules. For them, the advantages are significant: complete control, total anonymity, no human coordination required. For you, this means your transaction monitoring needs to identify accounts that behave like mules but have no real person behind them. Synthetic mules move stolen funds across multiple institutions, enabling money laundering at scale. This infrastructure supports terrorism financing, human trafficking, and drug trafficking networks. Here's what this means for you and your institution. Regulators are paying attention, and they're not happy. In January 2025, FinCEN, that's the Treasury Department's Financial Crimes Enforcement Unit, issued a landmark alert specifically about deepfakes and synthetic media in financial crime. The Federal Reserve published a synthetic identity fraud mitigation toolkit. Translation: if you can't detect synthetic identities, you're now on the regulatory radar. And here's the part that should concern every compliance officer watching this. Failing to detect synthetic identities during account opening is now considered an anti-money laundering program violation. That means examiner findings, consent orders, civil penalties. In recent cases, we've seen substantial fines and even criminal charges for institutions with weak controls. This isn't theoretical risk anymore. It's happening. If you operate in Europe or have European customers, listen up. The EU is raising the bar even higher. Their new digital identity regulations, effective 2027, will require biometric and document verification that's more rigorous than anything we've seen. The days of checking a name against a database and calling it verified, those are ending fast. All right, I've painted a pretty grim picture: AI powered fraud at scale, deep fakes defeating liveness checks, regulators scrambling. You might be thinking, is this even winnable? Here's the good news, and I've seen this work firsthand. The institutions that are beating this threat aren't using magic, they're using layers. No single technology solves synthetic identity fraud, but the right combination, that changes everything. Let's examine the detection technologies and defense mechanisms that actually work. The key insight: you need a layered approach combining behavioral, device, and biometric signals. Here's your defensive stack. Behavioral biometrics analyze how users interact with systems. Typing rhythm analysis detects mechanical patterns from bots and automation. Real users show natural human variation. Mouse movement and scroll behavior reveal predictable bot patterns. This technology achieves 98.7% accuracy against synthetic fraud with under 220 milliseconds latency. Graph-based analytics use neuromorphic neural networks to map entity relationships across accounts. This approach identifies fraud rings by discovering coordinated accounts and shared infrastructure. When 1,000 accounts share the same device fingerprint, phone number, and address, you found your ring. Advanced liveness detection has evolved specifically to counter deepfakes. Multi-frame passive liveness analyzes microexpressions and lighting consistency across video frames. Challenge response systems with randomized prompts prevent pre-recorded attacks. And here's the key metric: current systems achieve 99.1% accuracy on real IDs. But there's one technology that most institutions skip, and it's the one that ties everything together. Document forensics employs AI to examine over 1,000 security features: microprint elements, holograms, UV features. Metadata inspection detects signs of AI generation, including EXIF data anomalies and compression artifacts. NFC chip reading validates government-issued documents via embedded chips. Data correlation and intelligence sharing are essential. Cross-bureau validation compares applicant data against credit bureaus, Social Security Administration records, and telecom data. Device fingerprinting identifies coordinated fraud through hardware signatures. Velocity analysis tracks application patterns across institutions. Machine learning integration brings it all together. Supervised learning identifies known fraud patterns at scale, patterns your human reviewers would miss. Unsupervised anomaly detection finds novel attacks you've never seen before. And here's the metric that matters to your CFO. False positive reduction improves by 75 to 90%. That means faster approvals for legitimate customers and less friction in your onboarding. The system learns and adapts as fraudsters evolve, so you're not always fighting the last war. Here's the strategic reality you need to understand. Onboarding is your critical intervention point. Synthetic identities are most vulnerable right then, before they embed themselves in your systems. Once a synthetic ID passes your initial checks, it gains apparent legitimacy. It builds transaction history, it looks like a normal customer. And at that point, detection becomes exponentially harder and exponentially more expensive. The window is narrow. This is where you win or lose. The detection window at onboarding allows for silent background checks, signal correlation, device analysis, behavioral signals, all running in the background. The goal is minimal friction while verification happens without degrading customer experience. Implement graduated response systems. Low risk alerts trigger additional authentication. High risk indicators mean immediate account suspension and law enforcement notification. Early detection equals prevention. Late detection equals loss recovery and costly investigation. Post-onboarding monitoring continues the defense. Continuous screening with real-time transaction monitoring catches anomalies. Behavioral profiling establishes baselines and flags deviations. But remember, once the synthetic profile has transaction history, it appears legitimate, making detection significantly harder. Let's ground these concepts with real-world case studies that demonstrate the scale and sophistication of synthetic identity fraud operations. Case Study 1, the Atom Arena Ring in New York. From 2011 to 2013, 13 co-conspirators created over 20 synthetic identities. They created shell companies that reported these synthetic identities to credit bureaus as employees and customers, legitimizing them from the inside. They orchestrated credit building, then coordinated the bust out. Total impact: 1 million from banks plus another million from COVID relief programs. Case Study 2, the Ontario Fraud Ring in Canada. This operation ran from 2016 to 2024, 8 full years before detection. 12 perpetrators managed over 680 synthetic identities, $4 million in confirmed losses. The key lesson: fraud rings can operate for years if financial institutions don't share intelligence. Case Study 3, COVID relief fraud in Florida. Approximately 700 synthetic identities were used to apply for Paycheck Protection Program funds. The fraudsters exploited emergency lending with relaxed verification during the crisis period. Over $3 million were diverted from legitimate small businesses. The lesson: regulatory relaxation creates opportunity windows for synthetic fraud. For perspective on scale, the largest detected ring operated 7,000 synthetic identities, causing $200 million in aggregate losses across multiple institutions over multiple years. And that's just what was detected. Much larger undetected rings almost certainly remain active. How is the industry responding? FinCEN is deploying data-driven enforcement using machine learning analytics to identify patterns across over 1 million currency transaction reports and 87,000 suspicious activity reports. BSA obligations now extend to SEC-registered investment advisors effective January 2026. Industry collaboration is expanding. Cryptographic hashing allows institutions to share alerts on blacklisted IDs without exposing raw personal information. Federated learning enables institutions to train machine learning models on shared fraud patterns while preserving privacy. Information sharing consortia bring credit bureaus, banks, and fintechs together to coordinate intelligence. Technology investment trends show integrated fraud and AML units breaking down traditional silos between fraud teams and compliance. Real-time intervention systems stop fraud during transactions, not after settlement. Privacy-preserving AI maintains security while protecting customer data. Looking forward at the threat trajectory, synthetic identity fraud losses are projected to reach $23 billion by 2030, up from $3.3 billion in just the first half of 2025. AI democratization means smaller actors can deploy increasingly sophisticated attacks, and deep fake quality continues improving. Real-time high-fidelity face swaps are increasingly accessible. Here are your strategic imperatives. First, shift detection focus from post-transaction to onboarding. Second, invest in behavioral, device, and biometric technology stacks. No single technology is sufficient. Third, enable real-time monitoring infrastructure rather than batch reviews. Fourth, participate in industry intelligence sharing through federated learning and blacklists. Fifth, prepare for regulatory scrutiny by documenting your synthetic ID detection procedures. Sixth, update KYC and CDD frameworks to incorporate graph analytics and behavioral signals. Seventh, build the business case for senior leadership on the cost of detection versus the cost of fraud exposure. Here's what keeps me up at night. Synthetic identity fraud isn't a problem we solve once and move on. It's an arms race. And right now, I have to be honest with you, the criminals are winning. They're leveraging AI, deepfakes, and automation faster than most institutions can update their policies. But the institutions that survive this, and I've worked with teams that are doing it, they're the ones treating fraud detection as a live operational capability, not an annual compliance checkbox. They've moved detection upstream to onboarding. They're layering multiple signal types. They're sharing intelligence instead of hoarding it. The question isn't whether your institution will face a synthetic fraud attack. You already have. The question is whether you'll catch the next one before the bust out. If this deep dive was useful, hit subscribe. I go deep on financial crime threats that actually matter to your work. Next week, I'm covering account takeover fraud and the new techniques that bypass multi-factor authentication. You don't want to miss that one. Share this video with your compliance team, your fraud investigators, anyone building your defensive stack. And here's what I want from you. Drop a comment below. What synthetic identity patterns are you seeing at your institution? What's working? What's failing? This isn't just content, it's a conversation. Let's figure this out together.